There's a classic supply and demand constraint right here that plays in favor of what you guys are doing, because you're actively getting involved to deliver supply right now. And you're forecasting that there's going to be less supply coming in even than we have right now, because of where the permits are, and there's a cycle to build that stuff. It can take a couple years at least until, frankly, that comes on market for people to go into affordable housing.
And then another way to look at, again, supply demand, right? Supply for us is hotels to convert.
Welcome, everyone, to the Directed IRA Podcast. This is Matt Sorensen. I'm joined in studio by Adam Hooper and Ryan Sudek from Sage Investment Group. And we're going to talk about maybe making money and doing good. I think one of the biggest issues in real estate right now is we don't have a crisis, I think, in debt or anything like that. I know everybody cries about debt, but we have an affordability crisis in real estate. And you guys are trying to solve for that. So, Ryan, why don't you guys tell us about Sage and what you guys are doing from a big picture? And we're going to drill down into kind of your investment thesis, where you guys are seeing opportunity. But what is Sage and what are you guys up to?
Yeah, thanks so much for having us, Matt. Excited to be here. So Sage's mission is to help address the affordable housing crisis, like you mentioned it. And the way in which we do that is we buy underutilized hotels and convert them into vibrant apartment communities. So these are naturally affordable units for our tenants. And we've been doing this now for 5 years. So we have an Evergreen fund that we invite investors to invest with us, alongside of us. And we've done 22 conversion projects and have a big pipeline going forward.
Okay. How did you get into that? I mean, what was your guys' background, each of you? Maybe let's give some of the listeners some understanding. I've known Adam for a while from Real Crowd. We've done podcasts before virtually.
I used to be on your side. I'm in the hot seat answering questions today. I'm a little nervous here.
So why don't you guys both give a little background about each of you and kind of how you got to this concept and working on this?
Yeah, so again, like we said, we've been on a few shows before. And so my background, I'm a real estate guy. Been in the business for 20 plus years. The bulk of which, over the last decade, was running Real Crowd, as you said, which was an online investment marketplace. Really leveraging the 506c general solicitation landscape, which when I reconnected with Ryan, they had just transitioned from a 506b to a 506c, so they can advertise these deals, which was music to my ears, having done that for a decade. I think for me, after we sold Real Crowd in 2023, I got introduced to Ryan, probably about a year and a half ago now. And just fell in love with the concept, right? I think the affordability issues we talked about, there's just, I don't know how we're going to deliver new housing stock at rates and at price points that are affordable for service retail, people that are making $18 to $25 an hour. And I think it's important to make a distinction between capital A affordable housing and naturally occurring affordable housing. So we're doing all this without subsidies, without, any of the HUD Section 8 stuff, LIHTC, which just has its own, whole set of complexities. So to be able to deliver housing stock at this price point, which is anywhere, $600, $800 a month less than comparable new properties, which is super compelling from a real estate perspective. And so when I decided it was time to move on and reach back out to Ryan, they were looking for exactly what I had done for the last decade or so. And again, just couldn't be more thrilled to be on the team and try to solve that challenge.
Well, it's pretty compelling because, you knew a lot of people in that space out raising capital, right? You had a lot of connections in your spot. And so really to pick where you wanted to go and where you thought there was going to be opportunity, I think says a lot probably about
and
what
it
you
was
saw
just,
in Sage.
I think for me, in my internal philosophical why of what I was doing with my career, right? Again, been in the business for 20 years. We had $9 billion of transactions in the marketplace, so seen a lot of different ways of doing it. I didn't expect to find such an internal alignment with what Sage is doing. Real estate can be a fairly extractive business model, right? Even if you're buying Class C units, right? You're taking affordable units that people can afford, taking them out, renovating them, making them more expensive, which is kind of the opposite of what we're trying to solve.
True.
Exactly. And so it was just the alignment with everything and the timing. Again, I reconnected with him, and 8 days later I was on board. Yeah. So, and then the day before I started, he had a new baby, and so it's been a fun transition.
It's been so humbling to have you on the team. I had no idea that it was even an option, right? We went out to market to recruit for the role that Adam's in now, and then he reached out, and I was like, wait, this could be a thing, right? I can learn alongside someone who's been doing this for as long as he has and has as much perspective on what's out there in the market.
Yeah, because I think anyone that's going to be successful in what you guys are doing, you have to combine two things. I mean, you've got to have good deals and good deal flow, right strategy to do real estate. But if you're going to do it at scale, you got to be able to raise capital to go execute on that strategy. And I was at a conference recently, and I was moderating a panel. It was a great conference, you know. Larry Summers was there. I was like, I spoke right before Larry Summers did, you know, and I was like, oh,
so you probably had a
cool.
packed house.
Yeah. I mean, they showed up for me pretty much, you know. He just was riding my coattails, really, you know. But I had this panel, a lot of sophisticated sponsors, most about $500 million that they have of assets of, like, you know, under management type funds. And I asked one of the guys there, I said, what's harder right now, finding good deals or finding the capital to execute on the deals? And he said right now, finding good deals is harder.
Yeah.
And what do you guys think about that?
I think it's changed for us recently.
Yeah.
I would say that we have a large pipeline that's been cultivated over the past almost 6 years now. So we did our first hotel conversion, actually not too far from here in Tucson, Arizona.
Okay.
Back in 2019.
Okay. So talk about that.
Yeah.
Why did you decide to do that? Because that was your first deal.
That was our first deal, and I've only been with Sage for about 2 years now, even though we've been together as a fund for 5 years. I've known
and you're the CEO.
CEO
Okay.
of Sage. So I was brought on by my business partners, Ross and Emily. You know, we've all been investing for, you know, a long time now and always focused on adding value to whatever we're buying, trying to force that appreciation. And so an opportunity came along in Tucson. It was to buy a property right down the street from University of Arizona. Old hotel, 1950s built. Half of it had already been converted to housing.
Okay.
So you could see the business plan there. We had to convert the second half. So bought it in 2019 for, you know, $11.2 million. Actually, that was our total cost basis, including renovation. Converted the second half from hotels to what we thought was going to be student housing, because we were right near U of A.
Yeah.
Like, hey, this is going to be great for students, especially focusing on international students coming to the States. We delivered it in COVID. You know, U of A, there were no students on campus.
I know. I had a daughter there during that time.
And so we pivoted the marketing strategy and it leased up like that.
Okay.
And so that property still stayed, you know, 5 to 6% above the prevailing occupancy in that market. And we ended up selling it 19 months later for almost $19 million.
Yeah.
$19 million, generating a really strong return. That was the proof point for us. It was the light bulb moment, so to say, where we're like, okay, clearly hotels are fundamentally worth less from a cap rate basis or revenue multiple, whatever valuation metric you want to use, compared to what they would be worth as a multifamily property. And so you kind of, during that time, there was a lot of capital flowing into value add multifamily. Debt was cheap, equity was cheap. Everyone and their brother and mother and sister were trying to get into real estate, and so we carved out this niche, and we've figured out there's a lot of challenges that we've had to work through, from entitlement and permitting and development. We've learned a lot, and it's our sole focus right now.
Okay. I think that to me, again, as a real estate guy, highest and best use is, you know, real estate underwriting 101, right? And to be able to take these functionally obsolete structures, you know, from a sustainability perspective, from a lack of waste, right? We're not tearing stuff down. We're not adding, you know, a ton of new resources into the ecosystem. To be able to convert these functionally obsolete structures into cash flowing multifamily assets from the fundamental real estate strategy just makes all the sense in the world. And there's, you know, it's hard to say limitless anything in the real estate space. There's virtually limitless demand for affordable housing, right, in the area that we're going after. So the fundamentals are just really, really solid.
And maybe to put a couple numbers on that, I mean, we're creating these units for about $100,000 per unit on average, was about 50% of the replacement cost. And we see about a 50% increase over our cost basis, you know, once we complete the renovation and lease.
Because I guess that's the question, right? Is like, you know, someone who might not be in this every day might say, why don't you just build new multifamily? You know? The cost is very high to build right now.
It takes a long time too.
It takes time.
That's
3-4
years from now, you know, we're delivering these units to market. It takes us 6 to 12 months once we buy the property to do the renovation. So we're addressing the needs sooner. We know what the market is. We're delivering into a similar market in which we're underwriting. There's less risk, right? There's more controllable risk, less external risk because we're doing it in a shorter period of time. It's 50% of the cost of new construction. And we can charge rents that are naturally affordable because of where our cost basis is. And our units are smaller, but we fully amenitize them. We fully renovate the units. We add kitchens, so they live like a brand new Class A studio apartment. They just happen to be less expensive.
Yeah. So a lot of people think, well, why don't you just do office? There's this office glut of available office opportunity. I think I have perspective probably on the answer, but you probably have a much better answer. Like, why not do office conversion too?
It's been interesting, right? A lot of the coverage and the conversation has been around office to resi. It's orders of magnitude more difficult. The floor plates just don't make sense.
Like the plumbing's not
plumbing,
there.
the infrastructure isn't there.
It's different
like
having one bathroom
on the floor or something.
Or even just having a central core with elevators and no hallways, right? If you need to create rooms, right? A typical office plan is open, right? And with offices around the exterior.
And all that takes money, right? And so if we're trying to deliver affordable, why aren't we taking a shell that's already a type of housing, right? And just make that into more permanent livable housing rather than
the only projects that I've seen that have worked to that point are luxury, right? We were just talking to a group yesterday that's been doing these projects in New York City, right? They've been doing office conversions. They pencil in New York City. I think I saw another one that was, another luxury tower. They're buying for pennies on the dollar, but it's luxury penthouse apartments, and then they're doing mixed use below. And that's just not what we're going after. And I think in most markets, it's usually cheaper to knock the building down and build new than it is to try to do the conversion.
Yeah.
Okay. So because of how hotel type properties are typically built, it's an easier conversion. You can do it more affordably, which goes back to addressing the affordable housing issue. And but that also is profitable for you. I mean, so I guess you could run the numbers, and maybe I want to do luxury, maybe I don't. You guys have focused on affordable housing. Why is that good from an investment standpoint? I think a lot of people get the case of, we got to address that issue. Like, I think even as just a parent, like, man, my kids need affordable housing. Like, where are they going to live? I mean, people don't want their kids in their house, in their 20s. And like, but, rents are high. And so like, and we just want that as a society too.
Totally.
But for me as an investor, I'm trying to grow and build wealth so I can frickin' retire. Like, and I think of my IRA in particular that I can invest in your guys' deal possibly, right?
Yes, of course. You can.
So like, how's it a good investment case?
Yeah, it's, again, this fundamental highest and best use, right? So generally, as Ryan said, we target somewhere between a 40 and 50% increase over our total basis once we deliver these into stabilization. One of my first mentors in the real estate space said, you're not going to get hurt falling out of the basement window. And where the hotel industry is right now, and just, post-COVID, how people travel, there's this kind of, Ryan, you talk about this kind of death spiral of hotels. The basis that we're able to get into these hotels at right now, $20,000, $25,000 a door, it's just such a compelling price to be able to get in there and have all that room to build the profit in. Again, I'm not sure how nerdy we want to get on numbers, but generally we're looking to stabilize between a 8.5%, 9% yield on cost, which, when you're even today's cap rates, you're looking at a 5.5%, 6% cap rate. 250 to 300 basis points in spread over prevailing cap rates that's a really juicy spread, right? And so there is, as we were talking before, this is one of the few areas that I've seen where you can have an impact with this investment, but you're not having to accept a lesser return to deliver that impact. And that's, philanthropic money and investment money are two different totally buckets, and never the twain shall meet. But this is truly one of the only strategies in the 20 plus years I've been doing this where you can deliver the impact and you don't have to accept a lesser return to do so.
And on the other side of it, we see it in lease up demand. We delivered a 100-unit property in Washington State last year, and we signed 19 leases in a week. And we had to call our property manager and say, hey, maybe we should look at those rent assumptions and maybe bump up rents a little bit. And we just see we're not altruistic with our investment dollars. Like, we are fiduciaries to our investors. Myself and our partners have invested the majority of our wealth into this fund that we manage now.
You're invested in the concept yourself.
Oh, yes, 100%. We believe in it to our core. But what we see on the other side, obviously the fundamentals of getting the right cost basis is the most important thing. You make your money when you buy, right? Another one of those adages in real estate. And so just being really patient buyers, it takes us 18 months on average from when we start talking to a seller and negotiating to when we buy their property. A lot of that is just being boring and knowing what we're going to buy at. Not chasing shiny objects. And another part of that is, obviously managing the permitting process and the development process. But on the back end, what we see is just super strong lease up demand. And what's really exciting for us and where we are in our evolution, we're going to deliver 13 projects to market this year out of the 27 in our portfolio. So really excited to bring, a whole lot of more inventory online and start that lease up process.
So let me ask about, I'm just trying to unpack this concept so people can understand, maybe you guys in particular, and how you guys approach your deals. Can you give me an example of maybe a deal you guys passed on where you're like, okay, this could have been a conversion, but we passed on it because it didn't meet whatever, objectives you guys had. Maybe we'll walk through like why that deal didn't work.
There's a couple scenarios that are running through my head right now, and a couple deals
because you look at a lot more deals than you execute on.
We look at so many deals. Right now, we've got 67 LOIs out. Of those, maybe a third will transact over the next 2 to 3 years. And there are thousands that we've said no to or we've underwritten.
Or you don't even send an LOI.
We don't even send an LOI, right? And so, some that we've gotten pretty far in the process, we've gotten an LOI, maybe even gone under contract on that have failed. For example, in a Colorado market, the county came in and wanted to assess impact fees. One of the biggest challenges with this business is working with the local jurisdictions to understand what the planning department and the permitting department is going to require of us. And so in this case, they had this, a new unit of construction, whether it's a single family 5,000 square foot house or a studio apartment that's being converted from a hotel, which we were, gets assessed, call it $12,000 in impact fees. Well, that blows up the model, right? And we only, luckily we have a head of planning internally who's a former architect that goes ahead and talks to those cities. That's just one example of, one of the deals that have failed because, we got into the nitty gritty of it and we just walked away. We took our earnest money with us and we moved on to the next deal.
So some cities or counties might say, we're not going to assess that or maybe they assess it at a lower amount, or they may waive it and say the area needs this.
There's been all types of. Again, you would think that
this is the nuance in this stuff.
Exactly.
Someone probably wouldn't think of.
But you would think that from and not to be political, but from like a local politician's perspective, from a city planning perspective, this is something they would want, right? But it's kind of
they're telling all their constituents they're solving affordable
they're running
housing
on this,
issue.
right? And then when we get in there and we start doing the work, then these things come up, and it's a relatively new model, right? So they haven't seen, there's not a lot of pattern matching of how this business plan fits within the very letter of their code, right? And so that's a lot of the work that we're doing ahead of time. And I will maybe push you to touch a little bit on the team that you've built, because that to me was one of the most impressive things was the people that Ryan's building this team with. Just from the experience and being able to get ahead of that and do some of the storytelling when we go into these markets, and then the managing of the construction, and just there's a lot. It's a simple business to grasp, but it's incredibly challenging to execute. And I think, again, having done 20 plus of these, I think we've got to be probably near the top of firms that have executed. So
I think that's right. Yeah. And to give the politicians a little grace, they all want it and they all say the right thing and they're trying to do it. It's really just the code book. And there's a lot of folks that are, career folks in the local governments just trying to do the right thing. And to Adam's point, they've never seen this before. And so we have to come in. And so we have, a head of planning, Jeff. He's fantastic. Been working with him for quite some time on these projects. We also have a head of community relations, Whitney. And together, they're coming in and educating these planning departments, city councils, local HOAs, all of the folks that are surrounding the property or might have a vested interest in where this goes, to say, hey, here's our plan. Here's what we're not going to be. Here's what we are going to be, right? We're not a homeless shelter. We're not, going to allow the, potential crime that's been at these hotels to continue. We're going to deliver a vibrant community that's addressing a real need for the people that live and work near you, right? We're trying to help those folks that make too much, they don't qualify for the government assistance, but not enough that they can live in that Class A that we were talking about earlier. So that advanced team of Jeff and Whitney and our construction management team get in with the city. And now it's not just about selling the vision of what we're creating, but getting down to brass tacks and saying, all right, here's how we've seen the energy code interpreted. Here's how other cities have asked us to do X, Y, or Z thing. We know we're going to have to, make sure we have fire suppression. We know we're going to have to, add electrical panels. But there's so many other little nuances, whether it's electrical vehicle charging or bike parking or energy credits, that we can have a proactive conversation and head off, because we've learned so much, having done 22 of these now, to say, all right, we're going to proactively work with you. Here's how we've seen it done before. Do you agree with that? And we're having those conversations before we're ever committing to, fully to a purchase.
Okay. So that was a good example on one that you're like, I didn't expect that, and we didn't want to do that deal because of some of the impact fees and costs that would have been in the mix. What is a deal, maybe give an example of one where you're like, this one is going to be an awesome deal, where you just saw it and you knew it was going to be an awesome deal?
Yeah, I think more and more, Adam touched on the distress that exists in hospitality, and more, given our track record and reputation, lenders are reaching out to us. And so, for example,
it's a great way to get deal flow.
It's a great way to get
deal
flow.
It is. Certainly
not buying retail.
Certainly don't want to relish in other people's, unfortunate failures. But it's a good thing for our investors. So, for example, in December, we closed on purchase of 3 properties in Texas. Okay. So 2 hotels in Houston and 1 in Dallas. Those were previously purchased for $74 million 3 years ago. Okay. Or 3 years before we bought them.
They were a combined deal?
Combined deal.
Okay, all right.
We purchased it for $37 million. All
right.
And got forbearance from the lender. The note on the property was $50 million.
Yeah.
And so, those were newer vintage. They were 2000s vintage. They had been renovated. Right. They already had the fire suppression and the electrical panels. It's the skinniest renovation that we've ever had. We're spending actually about $15,000 per unit in renovation cost. But great deal for our investors to pick up that and the renovation timeline is going to be 6 months. So we bought those in December. We're already starting to deliver units here in May.
Yeah, and that was a lender that was on the first project.
Yeah,
in
they
Tucson.
lent on that first project in Tucson, and it was actually here in Phoenix a year before we bought the property that they reached out to us and said, "Hey, we've got a problem. Can you help us fix it?"
Yeah. That's awesome, where you get to a point in your business where people know you now, and you're like, and they've got a problem. I mean, the lender's got a problem, right? But they know you know how to solve that problem.
Exactly.
I mean, they go straight to you.
Totally. And that's not just a flash in the pan one-time thing. Our next acquisition actually is in a market. It's a 10-minute walk from 2 other properties we own. We're buying it out of receivership for a little more than the cost of the dirt from another, a failed conversion group. The same thing with the Texas properties. There was someone who tried to do the conversion. Yeah. They had budgeted about 1/6 of what they actually needed to spend and, bought in a low interest rate environment. And so
what's going on in hospitality while some of this stuff is in distress? I mean, I've just heard individual stories here and there. I don't know if it's representative of the market, is that a lot of these brands have upgrade requirements and they're not being updated, and they were getting kind of kick the can down the road through COVID, and now they're really outdated, and they're like, all right, we're going to drop whatever flag you're throwing up right now. Exactly. If this is Marriott or whatever brand you're under, and you're going to be independent, and good luck.
Yeah.
I mean, what is happening?
It's a tough chart. You articulated it quite well.
Okay.
Post-COVID, you had a reduction, or during COVID, there was no travel.
Yeah.
Post-COVID, you've had a huge reduction in business travel. Also, for leisure travel, we're just not staying in the same way we were before. We're not using the roadside inns and traveling by car. We're doing,
and they got the Airbnb competition.
Exactly. Stole the words right out of my mouth. Exactly. And so as a hotel operator, you do have these what are called PIPs, or performance improvement plans, where Marriott or Hilton or whoever you're a franchisee of is going to say, hey, your countertops need to look like this now. The carpet needs to look like this, because they want to hold their brand standard. And if your income's been down, or you're not making any money, you haven't been saving away for that performance improvement plan, so you drop a flag. Yeah. And this is kind of the death spiral that Adam alluded to. But once you drop a flag, then you're charging less, and it's a slippery slope to then getting, being independent. You add on, distress from debt. There's also a really interesting kind of demographic feature of hotels in the United States. So over 60% of the hotels in the U.S. are owned by people with the last name Patel. So a lot of Indian families immigrated to the country, in the 70s, 80s, operated these hotels, educated their kids. Their kids are very successful, and not wanting to operate. And now the parents and grandparents are looking to retire and exit out of this hotel or motel. And so we meet a lot of sellers through those networks as well that are in that situation.
Yeah, I think a lot of people, if they don't understand the hotel hospitality industry, think, oh, Marriott owns that Marriott. No.
Very few.
Yeah, they're like operating that, and there's an investor group or an individual or family that actually owns that hotel. Like the real estate has responsibility for the upgrade, and so okay, well that's interesting. I mean, that's kind of some things I suspected, and I mean, is some of the debt issues also part of that, where there's been some people have acquired some of these and they've had floating and rates have gone up. Is there some of that happening too that's caused some distress?
Yeah, I think, and again, in this conversion space specifically, right, this became a bit of a, it's an incredibly interesting strategy, but I think a lot of people were starting these projects when, 2021, 22, when money was free, basically.
Yeah.
And to Ryan's point, didn't necessarily understand all the complexities of execution. And so, a number of these properties that we're seeing on the market now are coming our way. We're from traditional multifamily operators that thought this was just going to be another value-add multifamily project.
Yeah.
It's not.
Yeah.
Totally different level of complexity in actually executing. So I think we saw a lot of that where that's maybe a debt component.
Okay.
And then just back on the general hotel industry, it's similar to what we're seeing in office and other categories, that COVID kind of accelerated this bifurcation of the super amenitized luxury, really nice properties are actually doing quite well right now. They've rebounded really well, kind of the revenge travel coming out of COVID, where you're going to the nice places. And then the super, super low end, super budget, just, cash stay kind of places. Those are just going to kind of continue along. And it's that middle market that's really taken the biggest hit. And those are the perfect properties for us. 100 to 200 units, good demographics, good population growth, good employment centers that we try to target in that space.
And even within those markets, right, they're located where our residents work. Right. They're in retail quarters, they're in commercial areas. They're the second largest expense for our tenants is transportation. And so if we're on a light rail line or near a bus stop or a walk away from where they're working, like it's fantastic for their experience, and they're going to stay longer. We actually see this translate into longer lease times. That first property in Tucson, we see average tenancy 50% above the national average. Our tenants are staying for 22 months on average, whereas the national average is 15 to 16 months.
Okay. Let's talk about IRAs for a second.
Let's do it. Of course, yeah. That's why we're
here. You can't help that, so I'm going to want to squeeze in here. I mean, you guys have had IRAs invest in your fund, so you're familiar with that process. I mean, why do you think it's something good for someone's IRA? Maybe let's just talk about that. Most people with their IRA, their objective is to have the biggest account possible when they hit retirement, right? Like, how do you approach someone that's like, hey, I've got an IRA. I might want to invest in your guys' deal. Like, help me understand why that'd be a good idea.
Yeah, again, this is one of the attractors to what brought me to Sage, was how the firm was set up. It wasn't from the, I'm an institutional investment banker, hedge fund guy, this is how I'm going to real estate. Right? It was very much as a wealth creation channel for Ryan and for Ross and Emily and all their investor friends that were, building this platform since 2010, really. And so the way that the Evergreen fund is run is really a wealth creation vehicle, right? To be able to recycle the capital within the fund, put this capital to work in a hotel. Generally underwriting, we're looking at a 2.5 to 3x on the underlying assets. Take that capital, recycle that into the next deal, and just continue multiplying that over, in perpetuity, basically, through this fund. It's just a phenomenal wealth creation vehicle, right? And so that to me was another interesting strategy of the Evergreen fund, whereas the bulk of my career has been on just asset by asset capitalizations. So that was a change for me to get understanding around this Evergreen strategy, but from a wealth creation perspective, and again, trying to just grow that account balance over time, I think it's just a fantastic way to compound that with that recycling of capital.
And I think a lot of people with their IRA are investing in a 10, 20-year time horizon.
Super long term. I
think a lot of people with their individual cash, they might be like, well, I want that in 1 year, 3 years, 5 years. I may not but people's retirement accounts, if you're in your 40s, you're like,
let it grow.
I'm not touching that for 15 years, 20 years, but so.
And also I think for some folks, it's challenging to find the next opportunity.
Right.
Who knows if you invest in a project today that's going to sell in 5 years from now, who knows what the market's going to be in 5 years. I think with us, you can kind of either be very active, and that's where I started, right? I started doing my own value add multifamily, and then I became passive and into an investor in the fund, into our fund as Sage, and I did it through my self-directed IRA, a portion of it, and just saw a lot of value to kind of trusting people who are experts and believing in the business strategy, so that I wasn't trying to 1031 exchange and find that deal and make a bad investment to try to save on the taxes or and all of these different things. So I think there's also some self-dealing things that come into play. So if you want to get access to real estate, you want the forced appreciation that comes from our underlying fundamentals and the compounding effect. We also have cash flow. We've paid 17 as of this morning. Our 17th straight quarter of distributions went out. And so we've got that nice balance of cash flow as well as equity appreciation.
Okay. And you guys described it earlier to me. You have your fund. You've got 20 assets right now, approximately 22, you said, or?
So 27 total assets, 22 of which are the hotel conversions.
Okay.
Yeah.
And so each of those, the fund has a SPV, like an LLC that owns that specific asset. Mm-hmm. And so those are all rolling into one fund. So you're spread out between different properties rather than just one deal.
Yeah, the folks who invested with us in 2021, for example, are so much more diversified now, and they're still getting the compounding effect of these new projects coming online. And so, that is a benefit. As an investor with Sage, you own a piece of every single one of our properties, and it helps us balance that cash flow and equity appreciation. Right, we're raising money for new acquisitions. We see that big pipeline of opportunities, but we also have other deals that have already been leased up that are completing construction. We're doing cash out refinances, and that capital being spun off of those deals also provides that balance of cash flow, but equity appreciation for folks that are new coming into the fund.
Yeah. So let's talk about, though, what if I want to get out eventually? Maybe I'm going to be in for 5-10 years, whatever my retirement horizon is, and there's cash flow getting spun out, so that might be hitting my IRA, and I can take some distributions. But what if I want to sell out? When you're investing in a fund, it's not liquid. Like you're in the stock market, a lot of people familiar are like, sell, but how does that work if I want to get out at some point? Because the fund's not going to close out and sell the property. You're going to keep going.
Yeah, so it's a 5-year commitment that we ask for from our investors. It used to be 10 years, so we've got some investors committed out through 2032. But anyone that's joining us now, it's a 5-year commitment. After that, you have a right to redeem your shares for cash. And so we'll buy back those shares, either from cash on hand, from a cross-collateralized loan. The way that we've raised our capital is, over the course of the last 5 years, it's tranched out. So, our anticipation is not needing to sell assets, but to have the liquidity for folks who want to redeem at the end of 5 years, or they can choose to stay in. Mm-hmm. We also allow folks, especially this might make sense for IRA investors, to reinvest their distributions and buy additional shares so they can keep that compounding and make sure that their capital is continuing to work for them. So that's another nice feature of the fund.
Okay, awesome. What about other strategies, other investors? You have obviously people investing personally. Mm-hmm. What about people doing 1031 exchanges?
Yeah, so that's...
with a fund, sometimes that's tricky, if not... I don't know. How do you guys...
Yeah, so we are. That is going to be a big area for us. So we've got this next one that we're closing actually in, I guess, a couple weeks now. Yeah. I think we got 4 different parties coming in from a 1031 exchange.
Okay.
So it's actually a 2-stage process. So we'll do a 1031 at the property level. We'll create a TIC, a tenants in common.
Okay.
So they'll do that into the tenants in common to satisfy the 1031 exchange. And then we'll do a 721 exchange into the fund, so basically an UpREIT. Mm-hmm. So at the end of the day, they can do that all tax deferred, and then they can take ownership of shares rather than an individual property with the tenants in common. Again, as a real estate guy, it's a very compelling opportunity rather than going into a DST or some of these other products where you're paying 14% for the benefit of working with them, and you just kind of get a really low cash flow. So I think from a optionality of the 1031 to take. A lot of the people that are coming in, they're tired of active management, right? They just want to kind of take their chips, park it somewhere, let somebody else do the work, right? Which is what Ryan's built this phenomenal team of doers. And then they can just hold shares on a tax deferred basis rather than having to go, find something and, identify in the 45 days, close it with 180, figure out the boot, figure out all the debt.
Yeah.
So we definitely work with 1031s. And I think that'll be a big area of focus for us going forward too, is getting into that space for another option.
Yeah, I mean, people have been seeing, appreciation in their real estate, particularly if you bought a while ago, and but we definitely see that, as tax lawyers in our law firm, is, what do I do next? And, I think for a lot of people, it's a little more difficult to make money in real estate, like the typical mom and pop that buy a single family rental.
Yeah.
And I think to be successful in this market right now in real estate, you got to have a strategy. You got to have the ability to execute on that strategy. I know you guys made that emphasis too. I mean, there's no shortage of ideas out there that are good. There's a shortage of people that can actually execute on the good ones.
Right.
Agreed.
And that's, Adam's kind of touched on the team that we've built. We've talked about kind of the advanced team of, community relations and planning. But, we're not just, not to put anyone down, we're not just sponsors. We're not just fund managers. Like, we're developers, right?
Yeah.
Like, that's where we started. My partner, Ross and Emily, both grew up in the construction industry. We've been doing this, like Adam said, since 2010. We've got now a team, our head of construction management, 25 years in the business. We've got a team of construction managers that are holding general contractors accountable, and then asset manager, an asset management leader who, again, 20 years in the business, has managed portfolio of 7,000 multifamily units in the past. And Dina's phenomenal. And so, it's the whole string where, obviously the capital's coming in, we need the right deals, we need to buy right, but we need to execute really strong so we go on time, under budget, and then we manage revenue expenses really effectively. And so we've got a team of almost 25 folks now that are focused on doing all of those core functions to make it all work.
Yeah, and I think, some of the most successful investors I know are always pivoting their strategy depending on what's happening in the market. What was working 2 to 3 years ago doesn't work now. What was working 5 to 10 years ago doesn't work now. And so you need to know the strategy. But I think there's a smaller set of strategies that work right now. Just because we do have this affordability issue. We have a little bit higher debt. It's not ridiculous. I mean, it's all relative to what we had a few years ago. Everybody got a little, cozy with low rates.
Right.
They're not terrible, really, if you think in the grand scheme of things. But still, it's a challenge for what people are used to. But some of these strategies, I think, are a little more sophisticated to execute on.
Yeah.
Like if I'm, an investor with a couple $100,000 or $300,000, and I used to be able to go do a deal, now I can't as much. And I really feel that as we go out in our real estate groups, people are kind of feeling that.
Yeah, it's the active value creation that is the fundamental to this, right? We're not banking on increase in market rental rates. We're not banking on debt rates coming down. We're not banking on cap rates compressing. It's that forced appreciation. We are actively adding value to these units and changing the use, right, from a non-functional hotel to a cash flowing multifamily asset, which it's a much more active value add strategy than putting paint on a project and hoping that your market rental rates continue to increase at, you're going to underwrite 5% per year just because that's what you underwrite at, right? That's just not how we operate.
Yeah. Yeah. And I think, it just seems, I was thinking about that, a lot of investors could have success just by kind of riding the wave.
Yeah.
Recently. And, again, a few years ago, you could be an idiot making money in real estate. There's so much going in your favor.
Yeah.
Rents were going up, property values were going up. And I'm thinking this could be multifamily and single family. But that's shifted now.
Yeah.
You got to be able to find and execute on deals at a higher level. And it's kind of, I think, taken some of the everyday investor, day job business owner out, I think, of having a lot of success in real estate. Sadly, I think it'll come back. There's always cycles to this. So is it a good time to invest in real estate, just generally?
It depends on what deal you're investing in. I am biased, and I'm going to talk my own book, but I look at a lot of different deals just as a real estate junkie, and there are very, 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 very few that I would invest in outside of what we're doing. Just to be in control of our own destiny with that value creation, we're addressing a fundamental need, and we can feel good about doing it and also have it be good business, which is great. I think it's a fantastic time to be investing in creating new multifamily that we know is going to have a lot of demand because it's naturally affordable. We're not relying on government subsidies or any special programs that exist out there. We are doing this just with straight equity dollars, partnering with banks and credit unions or debt funds to get debt on the projects, and we're executing. I think the other component of this is, we feel like it's got staying power because a lot of developers and folks building new construction have been pencils down for the last couple of years.
Yeah.
Interest rates spiked in 22. I remember going to a conference in 2023 and developers just saying, yeah, we're not doing anything right now.
Yeah.
And if you look at where we are in terms of deliveries, we've already peaked at multifamily deliveries. It's falling off a cliff. So as you look out to the end of this year into 26, 27, there's very, very little inventory that's coming to market because those projects had to start 3 or 4 years earlier, like we were talking about. And so for us, we love that there's a whole host of opportunities to acquire these hotels and be delivering into the end of this year and early next year when nothing else is going to be really delivering. Right now, we've got the biggest gap. Basically, since December, it's been the biggest gap between permits. So basically, people are starting to think about building and deliveries in history. And so I think there's a lot of staying power, and we can feel really confident about investing in this market. Given all the uncertainty, it's hard to find a lot of truths, but we're able to capitalize on some truths. Hotels are fundamentally worth a lot less than apartments are. Yeah. We know that there's an affordable housing crisis. Housing prices the cost of housing has gone up 85% in the last 4 years. And so we're addressing that by delivering natural affordability. And with those two trends behind us and those true truths in the market, I think we'll do well.
Yeah, I mean, there's a classic supply and demand constraint right here that plays in favor of what you guys are doing because you're actively getting involved to deliver supply right now. And you're forecasting that there's going to be less supply coming in even than we have right now because of where the permits are, and there's a cycle to build that stuff. It's going to take a couple years at least until, frankly, that comes on market for people to go into affordable housing.
And then another way to look at, again, supply demand, right? Supply for us is hotels to convert. Right? Yeah. And so we've got, all the dynamics that we talked about before. I think there's something like 70,000 hotels across the country that are kind of in this range that could be eligible for conversion. That's a lot of projects, right? That's a lot of units. And then on demand side for us, it's tenants, right? It's affordability, it's workforce housing in its truest sense. And so, again, I don't think we're going to run out of supply or demand anytime soon, right? I don't think we're going to nationally or globally solve this affordable housing issue in the next decade. I think it's going to be, changing with administrations and with policies, with, who knows what HUD's going to look like this time next year. So to be able to do all of this without the subsidies, without the reliance on that, and deliver this naturally occurring, again, I don't know any other strategies that are going to solve that right now. So I think that's where it's super exciting for me as a real estate guy to take this foundation that we have, 300 million of assets, 2,400 units, and I think there's a legitimate 10x right in the portfolio size, just kind of organically. I think there's so much runway for the strategy.
Yeah, and I think the economy rewards businesses and companies that solve problems. If you're just going out building luxury homes right now or luxury apartment buildings, right? I don't know that the economy is going to reward you. Maybe you play it right, you got the right partners, you can build right. I don't know, but I think when you're going in and solving a problem that's clearly there, everyone recognizes it. The supply and demand is there. People need this type of housing, and what can be affordable, what you can deliver at. You can pencil out the deals. I'm like, the company is going to get rewarded, and hopefully investors, of course, investing.
Of course,
they're going to get rewarded too. If you weren't doing this, though, I just have a question. We'll get a little off topic here for a second, and we'll come back and wrap up. But if you weren't doing this in real estate strategy, what would you be doing?
Good question. I'm super passionate about helping investors build wealth through real estate. There's a really formative experience I had when I was a kid. So my dad was an airline pilot, and post 9/11, the airlines went bankrupt. My dad lost his pension, took a 60% pay cut, but we had this small couple houses in our small town of Medford, New Jersey that I used to swing hammers with him on the weekends.
Okay.
My parents were able to survive through that challenging time because they had these cash flowing assets. And that was very formative for me. And so when my wife and I, were in the fortunate position to be able to start investing in real estate, I knew I always wanted that insurance policy for me and my family. So I think if I wasn't doing this, I'd be trying to build something to help, in the same way that Adam, built Real Crowd, trying to open up access for more and more people to participate in that. It's benefited myself and my family greatly to be able to have access to that. And also, understand what's a good deal versus not. I think to your point, there are a lot of deals out there. There are fewer good or great deals. And so I think that's where I'm most passionate. It takes a lot of capital to run our business. I wish we could, let people write $1,000 check to come into our deals, but
Stay tuned.
Yeah, exactly. Adam's team might need to be, 50 times larger. I'm not sure. And so I think that would be probably, it's just an area of passion that I get to tap into today. And so if I wasn't sitting in this, very, privileged seat that I get to be at, with an awesome team at Sage, I'd probably be building something related to that.
Awesome. What about you? What do you see out there in real estate? Like if you weren't doing this strategy, which I know you guys love, and it's a win-win for what's out there and what we need in affordable housing. It's great for investors. It's great for you guys. You're investing yourselves into this. So what else would you be doing?
Honestly, both my girls started playing golf, so and I'm helping coach a high school team, so I'm probably doing a lot more of that if I was in real estate. But no, as Ryan said, right, that was the mission that we started out 13, 14 years ago with Real Crowd, was to truly break down the barriers to access to this. And so what Ryan mentioned, bringing access is just, that's something I am deeply passionate about. I think what I've found, and it was funny, I was having a conversation with my wife before I ended up coming on board with Sage, and she's a stay-at-home mom, 3 kids, just that is a job unto itself that I don't think gets enough credit. And we were having a conversation of, I was looking for a change. We're talking about, does she need to go find a career, and just, for her to take the time to find out what would it be that would give her purpose, and what would she enjoy and find meaning in. And my reality at the time was I was the sole breadwinner. Like, that's just not really an option for me, right? I have to go find a job to make sure to continue to provide. And then when I ran into Ryan and what they're doing at Sage again, to find that alignment with solving this issue of affordable housing, I think it really, it struck something in me that I didn't know was possible in our industry to truly make a change, to make a difference and have an impact on the communities. So that's something that's really just awoken in me, since I came on board with Sage, and I've really found a passion with, is trying to solve this issue. So if it wasn't through this, I think there would be something again along those lines of just truly figuring out, what does this next generation of affordable housing look like, right? How are we solving it? There's a bunch of other interesting companies out there. One I met with a couple of weeks ago, they're bifurcating the land and the homes. So you finance your home, and they're buying the ground lease, and they're financing it with long-term life insurance money. So it reduces your cost of ownership. So bifurcating structures and ground, right? So there's just a bunch of, I think, new interesting opportunities in the affordability space that to me, that's probably where I would do something. But right now, I think, we scratch all those itches with where we're going with Sage.
It's like the second best strategy out there. You might do. I was just curious, All right. Well, I know you've got an incredible experience from what we did at Real Crowd, and we had great conversations on our podcasts. And so I appreciate you making the connection here with Sage. And we're starting to work with you guys, and having IRAs invest into your guys' deals. It's incredible, because I think for me, with self-directed IRAs, our goal is we want our clients to think of their retirement account to invest in the best deal they can find. That doesn't necessarily mean the stock market. And a lot of investors want maybe some diversification. They want something that's going to provide a better return. They want to invest in things that they think is the right strategy. And that's not all in the stock market. And sadly, a lot of the real estate plays you can do on the stock market are just correlated to the stock market.
It's still an equity, right? It's still subject to the whims of the irrationality of the markets, right? So private real estate is the non-correlation and the diversification. And I've always seen it in a lot of the work that we were doing before we sold Real Crowd, was in the registered investment advisor wealth management space. Real estate and private alts can be such a great counterpoint and an anchor to a portfolio that helps you sleep at night, right? We don't value it by the minute, right? We don't value it monthly, we value it annually. So you can kind of like sleep at night and just know that we're working in the background, we're doing our thing, we're executing. And then come the end of the year, when we do the revalue, we get to see, all the realized value that we've created throughout that year. And so it's a great augment to a portfolio of traditionally liquid equities that just provides a great counterpoint from a diversification perspective.
And what was I have a little bit notes on your background. So you went to Stanford and you did M&A for a while.
I did,
yeah.
yeah.
How does that helpful to doing real estate?
Great question. So for those who don't know, M&A, mergers and acquisitions, so helping big companies buy smaller companies. Did that a few different businesses in technology and real estate, places like Amazon and Redfin. Spent a lot of time there.
A small acquisition you might have heard about of a small company, Amazon buying another small company like Whole Foods.
Yeah, exactly. Yeah. I guess that's a big company buying another big company. But yeah, I've done deals from $10 million up to $14 billion.
Been a customer of both.
Yeah, that's right. That's right. And so, the fundamentals of that are very similar to what we do. So you're underwriting, when you're looking at an M&A deal, you're underwriting, in an Excel model, what you think the financial performance is going to be of these combined entities. There's an integration plan that you need to execute on bringing the teams together, across all the different business functions, from tech and engineering to operations to HR, legal, accounting, all the systems behind it. And you're leading with a fundamental business strategy and a market opportunity, right? Those same things exist here in real estate. We've kind of been talking about the market opportunity that we're going. We do the same, heavy, rigorous financial underwriting, and then you go into diligence, right? Yeah. Once you make an offer or an LOI to buy a company, you're meeting with the management team. You're trying to understand, is this asset what I think this asset is, as a third party? Now I'm kind of behind the curtain a bit, so to say, and you're trying to validate or invalidate any of your assumptions in the same way that when we get under contract on a property, we're doing thermal scanning. We're cutting open walls to understand where all the plumbing is. We've got the same inspector going out to every single property across the country to know what to look for. And then if you decide it's the right thing to do, you pull the trigger, you invest a bunch of money, and you need to perform against that plan, and you got to execute on the integration plan, which is, that's the key to success in M&A, and it's the key to success in being, a good developer as well. So a lot of analogies there, and I had the benefit of spending 5 or 6 years at Redfin too, so had some time in the real estate market, saw firsthand the fundamental challenges of affordability. I was running the partner agent program at Redfin with 11,000 agents, and watching customers try to transact on homes and losing out over time, and led the acquisition of a lender and of a multifamily marketing company too, and so spent some time in businesses around what we're doing here, and in helping property managers and owners market their properties, and helping consumers finance their properties. And so I built some teams too and run some businesses, had $100 million plus P&L with a big team. And so I knew a little bit about a lot on the business side, and then just kind of the fundamentals of allocating capital, but also executing on the business plan.
Okay. Awesome. I think, your guys' backgrounds are very interesting about how you guys can approach this and the experience you bring. Now, investors coming in, you have the fund, which is an equity fund. Mm-hmm. So I'm participating. You guys mentioned you're doing the dividends, you're paying out cash flow that's coming through. You're reinvesting, though, and buying more assets as you're doing that as well. And so if I'm invested in there, whether it's me personally or my IRA, this is not meant to be an endorsement, right? This is just, I just want to unpack this and get awesome experts on, so everybody do your due diligence. But I just want to understand the structure here if someone's interested. I'm participating in their equity component. I get appreciation as the assets are going up over time. I'm getting cash flows they're going in. But you also have a debt fund too, right?
Yeah, we sell notes that are secured by the fund. Not secured by the underlying assets, but we do have notes for those who are interested in kind of just a pure income play. Maybe give up a little bit of that upside for a little bit more of a secured position in the fund.
What's the terms on the notes, like rate and time?
Yeah, so it's a 12% current pay, paid monthly, and minimum term, 12 months is minimum. Usually like to see 18, 24 months. Again, if it's in an IRA, one of those kind of set it and forget it things, happy to look at terms there. But that's just, again, a 12% simple interest. Yeah. So that's a fixed coupon rather than participating in the equity fund.
Yeah, maybe someone wants to invest, wants that fixed coupon type thing, and wants to be out in a couple of years or 3 years or something. Yeah. Could be a way.
Totally. And to draw a contrast to the equity fund, which is our primary, capital raising vehicle, that's targeted between an 18 and 24% return, total return, of which 6% is estimated to be in distributions. The remaining is in that appreciation of the underlying security. And each year, as Adam mentioned, we revalue our share price based on independent appraisals. And so last year we had an 18% total return. and 6% of that was cash that went out the door to folks, and the remainder was in the increase of our share price.
Yeah. Well, awesome. I greatly appreciate you guys coming here, unpacking this. You can do good and make money at the same time. That's okay. There's nothing wrong with that. And you guys got an incredible strategy you're executing on right now, and congratulations on all the success that you've had. How do people learn more, though? And where, if someone wants to click on that or reach out to one of you guys, where should we go? We can put these in the show notes, too.
Yeah, so you can come find us on our website, sageinvestment.com/IRA. We've got a landing page there.
For IRA specifically?
Yeah, IRA specifically.
IRA
we do it right here, Matt. We do it right for you.
Right. So we've got a landing page up for folks. So that's sageinvestment.com/IRA. You can also reach out to Adam or myself via LinkedIn or emails as well.
Okay, awesome. Well, thanks so much for being here. And thanks, everyone, for tuning in to the Directed IRA Podcast. We'll be back next week with another incredible episode. Until then, stay calm. Self-direct on.
And thank you, everyone, for listening. A quick disclaimer and reminder. This presentation does not constitute an attorney or CPA-client relationship, and it is always in your best interest to consult competent legal and tax professionals when conducting your own personal transactions.
We also want to make sure this is not investment advice or financial advice. We're just trying to give you education, ideas, and strategies you can take to your professionals or conduct your own research on. We'll see you next time.